Welcome and good morning to Remax Hallmark Live. Please welcome Steve Tabrizi.
Good morning, everyone. Great to be here. Almost the end of the 2025, and I'm sure everyone is excited to understand what has happened in 2025 and what are our prediction collectively for perhaps at least minimum 2026. Uh, Before we start, let me stop this. Before we start our presentation, let us have a moment of the silence for our amazing friend Bruce Johnson. Thank you, Bruce, for everything you have given this world. We will carry your light forward. You inspired all of us. Your motorcycle ride for 70,000 kilometers and making an impact on many lives. Thank you. Okay, let's start. Let's take a look at the first. What I will try to do in the next 35 to 40 minutes to understand what really has happened in 2025 and how the market has unfolded and what are the key factors that they have impacted our market and what needs to be done in order that we come out of this sluggish market out and hopefully we can rebound in 2026, perhaps maybe in the late part of the 2026 and early part of the 2027. So let's take a look at what happened in perhaps last 4 years. Obviously, 2021, as you recall, due to the low interest rate, it was a rapid appreciation. And one of the best market to compare to the rest of the Canada was GTA. The average price was sitting anywhere between about the 1.1 to 1.2 million dollars. 2022 market literally peaked to the highest, and the average was about 1.2 million dollars. And in some segment, particularly the cottage country and recreational properties, they had an appreciation of almost 30%. And we continued that momentum till the first quarter of the 2022. And then once we were in 2023, we noticed the first decline in our market. And the decline happened due to the first time that the Bank of Canada starting increasing their benchmark and their bank rate. And in 2024, we noticed that the market was mostly flat. Why it was flat? The momentum of the 2023 and also the worriness of the rapid rise of the interest rate caused many buyers, they just basically sit on a sideline and understanding why the market is changing. The affordability was the biggest factor in 2024. And 2025, the prices has dropped. The benchmark price right now sits at about $956,000. And the concern beside the affordability interest rate, there is another concern, which is tariff and Canadian arrangement with US. And year to date, we are down about 7% in the GTA, and the average price has moved up a little. It's sitting very close to about $1 million. So if you take a look at from the highest peak to where we are right now, within the Ontario, we are down average anywhere between 15 to 20%. There are certain market that is higher than even 20%, anywhere between 24 to 31%, mostly in a cottage country, and also within the condominium market, particularly not a resale condominium market in pre-con and assignment. So if you have to do a regional comparison, Durham region had a very flat market, minor drop year to year, 3.7%. Ottawa and eastern of Ontario region, or overall eastern of Canada, is in a positive territory, not a major positive territory, but about 0.7 of the percent. And one of the main factors for those regions is affordability and employment sector, particularly in Ottawa. As always, the federal government employment and average pay is higher than the rest of the Canada. Greater Toronto area year to date, it sees about 4.3% drop in overall all category of the homes. And a lot of people may question this. No, this is not a true story. We are way beyond the 4% down. Yes, if you compare it again back to the 2021 and 2022, yes, we are anywhere between 15 to 20% in terms of the prices. But the most important thing is the volume. We are drastically down in terms of the volume of the transaction, anywhere between about 20 to 35% down in the transaction, depending on which region is your home it is or what region you practice. So if you want to also understand the net effect summary on each quarter, which basically we would like to describe it between the fear and positive, which was the FOMO and the greed. So the Q1 of this year, the rate starting to ease finally. And the Bank of Canada did two steps. One step, which they start increasing the rate rather than early in 2021. It started almost in 2023. And they did the same behavior also in 2025. Rather than dropping the rate fast, they actually paused dropping the rate till earlier part of this year, and they start dropping the rate. In Q2, economic uncertainty, although the rate was dropping, but the consumers still didn't have the confidence, and because of the economic uncertainty that has been caused by tariff and also slower population growth due to the immigration policies, and it also has caused the rise of the unemployment. Unemployment rose to about 7.1%, but right now is sitting anywhere between about 6.8 and 6.9. Q3, the famous phrase for Canadian economy for perhaps last 20 years, soft landing. We don't see a major drop of the prices in the last 2 years comparison. We do believe that the Canadian market really has found its bottom, not in every sector, particularly in pre-construction and the condos that they have been purchased anywhere between the 2020 and 2023. But we see the market really has found its bottom market. We also see basically there is a lower activity in a higher investor market, which is Ontario and BC. And as of today, the quarter is not done. We firmly believe that basically, yes, the market has been sluggish, but the market also has been resilient. I like to describe the market that we are in the speeding zone camera. We are driving, but we are not driving fast. So pre-con market, it's literally frozen. If you take a look at the active listing of the pre-con, if you take a look at the new completed and unsold unit under the construction, in all the three categories, the inventory has increased. And the main factor behind this increase of the inventory are basically the appraisal ratio. Most banks, they took at least about 10 to 15% of what was the purchase price. That's one, which has caused the difficulty of the approval for many of these investor or consumers that they bought this property. Particularly for investor market, also they see a major negative cash flow, and that's why we see a major spike in the inventory of the pre-con. So the pre-con market is perhaps frozen. Many of these projects are not selling, or we see some of the developer, they have dropped their price by almost about 30% from the peak of the market. If the downtown Toronto was selling anywhere between about $1,500 to about $1,900 per square foot, we can find on assignment basis units which were purchased at that rate of the $1,500 to $1,900, now at the average rate of about $1,200. In 905 area, we see that the units are selling anywhere in the range of 650, as low as 650 to as high as about 800 versus the peak of market, which was about minimum about 1,100 to $1,300. So property type comparison in the GTA, we see overall the detached home had a drop of about a 7% year over year. We see the semi-detached very close to the detached 6.7 and is sitting at a price of the 1,033,000. And we see similar pattern with the freehold townhome. And we see in the condominium market again year over year is about a 5% drop. That's why we believe in the condominium market that it's really slowly finding is the bottom line. But you see the pattern between the semi and freehold and the detached is pretty much identical. It demonstrates the behavior of the consumer that they are not really picking on one segment or one type of the property. Their behavior is across all type of the properties. So overall, what's happening with the Canadian economy? The inflation rate was at 1.9% about a few months ago. Now it's back to about 2.2% because there is a smaller drop in the gasoline prices. Grocery inflation still is the main concern for the consumers. Tariff and also the cost of the imports due to the weak Canadian dollars. You have to understand many consumers are under this notion that why the price of the groceries, why the price of the goods product are not going back to the pre-pandemic. I wanted to share this notion. It will never go back to the pre-pandemic. It's a philosophy of the business ecosystem. When the prices has increased and the cost of the goods has increased, even if there is a room to drop those prices, unless the suppliers, unless the business sector sees a massive retraction of the consumers on engaging on purchasing power, they will not drop their prices. Bank of Canada is sitting at a 2.25 rate, and the next announcement will be in December. And the market already is dictating that there won't be no drop in the interest rate. I personally believe the Bank of Canada is in a very good position because if you, in a correlation to the bond market and also the 5 years fixed mortgage rate, the mortgage rates are now sitting at anywhere between about 3.5 to about 3.9% within the market, depending on what type of the mortgage product you like to opt in. So we are pretty much to the market of the pre-pandemic. Another issue that we are seeing right now in our market is housing starts and construction. Although housing start year over year is a 6.8% up, but overall, the Canadian housing start is really down. We see some movement in Calgary, Edmonton, Montreal, and Ottawa, but we see a massive decline in Toronto and Vancouver. And in Toronto market, which is really a biggest market for the Canadian economy, a province close to about 16 and 17 million population, is seeing its lowest start since 1996. And there are shifting movement from the developer side, and mostly due to the cost and the demand. So let's take a look at the demographic shift. The biggest portion of the buyers in today's market are millennial. The average age of the millennial is anywhere between about 38 to 40. That's the average age of the first-time buyer. They represent in Ontario almost anywhere between 22 to 29% of the market. They represent about 61% of the market across Canada. Their main concern is interest rate, although is moderating, but millennials still are really selective with their choices, and they are under this impression that maybe the interest rate will go lower. Inflation has cooled, but not the way that they want it. And the reason behind it is that the income level of the millennial has not kept up with the inflation and with the cost of the housing. Affordability has not returned. Affordability has become better, but it's not in nowhere close to the point that millennials feel comfortable that they can jump the gun and buy the properties of the choices that they want. The market has shifted. The market is not anymore FOMO, any more emotion or urgency. Is more to a logic and optionality and personality of the individual and their choices. So this story has been shared before, but parents or baby boomer represent a massive portion of the down payment to the millennial. Millennial, they have done saving for a first-time buyer, but as you can see, almost 40% of that group of the population is basically benefiting from the gift and the money that they received from the parents. So they are truly dependent on the support of their parents. The latest survey by Abacus Data shows that 87% of the group of the buyers are still very concerned in terms of what is happening with the market. So, supply. Uh, if you recall, for the last 2 years, the focus was shifted from a demand to the supply. We blame originally there is too much demand. There is a massive, rapid population growth, so we need to keep up with the supply. Provincial government, federal government, they all came with different policies to increase the rental pool, to provide incentive such as a GST rebate, HST rebate to first-time buyer or the developer to support them to reload the supply faster. But the reality is, unfortunately, because of the drastic shift of the market from the investment perspective and adjustment of the price, and which does not make sense for a developer to build, there is a supply gap is reloading. Majority of the reputable long-term developer in Canada or in Ontario, they are not building as fast as they are supposed to build. If you take a look at the Ontario, the target for 2024 was 125,000, but they only achieved about 94,000 in 2024, so 76% of their target. So they were down 25% of the quota. And as you recall, Ontario Premier announced that Ontario needs about 1.8 million homes, and Canada needs almost about 3 million homes. Even with the drop of the immigration quota, we are still anywhere between about 25 to 30% behind our quota. And now that quota, perhaps once the data coming out at the end of the 2025, it will be a lot higher, because in the last quarter, many developers, they have pulled back and they have canceled their project. Doesn't matter, project of the condominium or project of the freehold or homes across Ontario. So why they have done that? It's a very simple business analogy. Prices are down, confidence of the buyers are down, so the home start drops. So when the home start drop, the supply drops. Once the supply drops, you will see the prices eventually will go up again. Developer, they do not accelerate in downturn. They wait for profitability to return. That's a simple formula for them. As much as we don't like their attitude, or they run a business. And as I said, the smart developer, the developer that they have a solid cash flow and solid backbone, that they can wait the next perhaps 6 to 18 months. They will watch the market and they will see where the market can find its price per floor plus profitability. So if this trends continue, even optimistic way, if we see 10 to 20% increase, not by 2026, by 2027, we will see a gradual absorption of the inventory, mainly due to the condo market. There are almost about 35,000 units are available in the market, and there will be more coming, the project that they are under the construction. So we will see a modest growth in the prices, and we will see slow affordability gain. But if it's optimistic, we will see also an impact on the GDP, because of the job market will slowly recover, And hopefully the government during this period of the 2026 to the early part of the 2027 also will reform its immigration policies and also supporting the developer. If this stagnation and not developing continue and drop another 10 to 25%, inventory of the homes that they are not sold may rise and we will cause another higher vacancy. So we will see nominal discount in the prices, and affordability will be limited, and more than anything else will impact the job market and impact the GDP. So weak construction investment is not good for the Canadian economy. Construction represents about 8% of the GDP in Canada. Housing, just the housing construction, housing start, it represents about $238 billion in 2024. Across Canada, it represents almost about 1.2 million jobs. If you also take a look at the direct and indirect businesses related to the housing, such as resale real estate, such as finance, such as insurance, such as home improvements, furniture, and everything else, it's almost represent 35% of the GDP of the Canada. So we really need to take a look at the housing start and construction carefully. It cannot be prolonged for longer period of the time. We really need to make sure that it really comes back at the, not a fast pace, but at least at the consistent trajectory, so we make sure that we don't lose that job market that we have. Canadian government has some immigration policies to making sure that we are protecting the existing job market, which we will talk about in the next few slides. So tariff effects. So it's very clear. Mr. Trump, or President Trump, we should be polite Canadian, in the first year of his second term, he has announced probably over 35 or 50 presidential executive order, and he probably retracted almost 90% of those orders. Right now, there is an argument in the Supreme Court of the US in terms of the overstepping his presidential power in terms of the tariff, and Supreme Court hasn't ruled in his favor or against him. I do believe the ruling will perhaps will be done completely in 2026 because of the midterm is happening. And the prediction for midterm is that the opposite party, Democratic Party, will take over one of the either the House or Senate. But overall, what it has caused, not only for Canada, but in the global market, uncertainty in the business sector, investment sector. When the business owner, doesn't matter, manufacturer, suppliers, investor, they see uncertainty in the market, they pause. The notion of the cash is the king, they hold on to it, and they wait, they see what changes is happening. But there are also opportunities in this market that some sector are taking advantage. But we have to take a look at the elements related to the tariff. One element is a demand. So that's why the Canadian market is sluggish and resilience, although with the tariff talks is going on for almost about a year. Job and confidence risk is down, but we haven't lost it completely. Why? Because the Canadian government start to cutting the rates, and population still is supportive. We still have a massive surplus of the 2023 and 2024 of the immigration population, such as temporary worker, student visa, and also the rapid incoming permanent residency that happened in 2023 and 2024. Supply, developer, by pausing them, actually indirectly for a short period of the time, remember, for a short period of the time, they're helping this resiliency of the market. So there is no over supply of the product. There is no price crash. We don't have many forced sell. So the definition of the forced sell versus the power of sell is totally two different things. The forced sells means a developer suddenly has 1,000 homes and they will do a fire sale of them. And the power of sells, although we do have now an increase portion of the power cell within the Ontario and particularly within GTA, but it represents only 0.3% of our market. Yes, it's about 11,000 direct or indirect power of cells in Canada, but it's not a major inventory in comparison of the total number of the homes for sale. The last is the prices, mid-down settlement of the prices. Construction cost is equal to the price per floor. Why it's happening like that? Why the developer are not building? Because at the moment, the developer in calculation, if the land cost is even, it's zero, construction costs, the development charges, commission, carrying costs of the construction loan, mortgage, or anything else, it's literally at par. So there is no benefit, there is no profit left for them. Transaction, as we discussed, is flat, and the forced selling is quite rare in our market. So what are the impact of the tariff? Southwestern of Ontario, Hamilton, Niagara Falls, it's high. Windsor, it's high. Auto and steel, slower job growth, and the buyers are more cautious. Golden Horseshoe, service-oriented industry, banks, insurance, tech innovation. Medium, the job market is there. There is no major impact. There is no major layoff or many layoff that is be the topic of the news. The market is moving at a very flat rate. Simcoe, Durham, and Niagara, they are good market. Medium sensitivity. Why? Because they became more affordable for the buyers, particularly first-time buyer to buy it. Ottawa region, of course, federal employment, more stable, fundamental, so sensitivity is quite low, although the federal government has announced a drop in a federal employee, but the number is not massive, and they are planning to do this gradually. The announcement was about 13,000 reduction of the labor force in the federal government. And if you take a look at on the grand scheme of the number of the employee that the federal government has, it's a small percentage. So let's take a look at the immigration. What happened in the last several years? Canadian really view the immigration in a negative way, that they believe that we are facing this affordability issue, high prices because of massive inbound of the immigrants, temporary worker, student visa, and the policies, they were wrong. I do agree and disagree. I do agree that the policies can be better, but I disagree also in overall picture that do we need immigrants or we don't need immigrants at all. This was the biggest challenge for consumers, massive growth of the population compared to the housing completion. As you can see, the correlation does not match. Literally 1/3 is in housing completion, and the growth of the population was almost 3 times. This is a bad policy. This is a policy that basically should be referred at how Canadian government should be able to integrate new immigrants, permanent residency into the country. One part of the integration is housing. If we be able to have a proper policies, could be in the rental pool, could be in the ownership pool, so the integration gets done faster and better, and it will be overall not a burden on the society and the services that the provincial and federal government provide. For the first time, government in their budget, they had an announcement called immigration management in a direct correlation of the housing capacity decision. So it's never been mentioned, but now they are for the first time acknowledging that they indirectly cause inflated demand. How they are now dealing with this issue. So they are reducing the immigration for the next 3 years by about 400,000 new comers, basically a 45 to 46% reduction. So we are going from the increase of almost about 750,000 new permanent residents. Total immigrant per year in 2023 and 2024, it was anywhere between about 1 million to 1,200,000. That's accumulation of also student visa and temporary visa. But an actual landed immigrant was sitting anywhere about 650 to 750. The number never been given accurately due to the process that it takes to complete an application. But now they are back to the quota of anywhere between about 350 to 450. So national housing gap expected to shrink by 534,000 units, basically 658,000 units remain unmet on an annual basis. So developers are not building, even though we are reducing the immigration policies, we are still in the negative territory in terms of the matching the quota. Permanent residency is going to be less than 1% of the population. It was a 2% almost, now is less than a 1% of the population. But even with the less than a 1% of the population, Canada is a leading country in the G7 country in terms of bringing that amount of the immigrant to the country. Temporary residence is not abandoned completely because we need the temporary workers. We need support of our universities with the foreign student. It's dropped by about, is reduced to 5% of the total population. So if you take a look at the effect that is going to have this limitation short term, everybody's happy. Everybody says ease of pressure on the services and housing. Everybody feels that like a relief. But in the medium term, fewer workers, less GDP growth. And as you know, Canada aging population needs immigrants, and a skilled trade shortage will continue. Average age of the construction worker, direct relationship to our industry, is about 63 years old. And most of them, they are not retiring because it's a good pay sector and there is hardly any replacement. It's coming. Those are the areas that the government, hopefully, under the new Carney's plan, will continue and focus on bringing the skilled worker, the worker that we need into the country. Long-term plan, if we continue this trajectory, fewer taxpayers to fund the pension and services, and aging population crisis intensified. There is an argument here by federal government, which is very interesting argument, is an argument of the AI. Do we need an increase of the population by the rate of the 1%, or maybe we need at the lower rate? Because there is an argument that some of the lower level skill work can be replaced by AI. This is something that no one really knows how the AI will evolve. I firmly believe, yes, AI will impact the employment sector, particularly not the non-niche market of the employment sector, and the sector that they basically, maybe they do more basic or job that the AI can replace them, but cannot replace them 100%, because we need still human interaction and human element to control the process of the productivity. So let's take a look at also the government policies and global opportunities. What happened to our immigration? What happened to policies that the government in the last 9 years, the previous liberal government, they sadly, I have to say, they created a chaos for our market, and more than our market, for Canada. So are they better policies in Canada or worse policies, or are better opportunities somewhere else? So economic cash flow, people who are directly or indirectly operate within the real estate business, the impact level has been very high. So negative monthly cash flow, people are saying, do I want to go to Canada? Do I want to invest in the real estate market? Do I want to expand on the opportunities the hedge fund companies, big companies get involved in the perhaps more investment housing, on adding more housing rental communities to the pool. They are all looking at the economic factor and also the cash flow and taxation in Canada. Tax policies are quite high. Layered taxes. Yes, we blame foreign buyers, we blame foreign investor for a Canadian market that they caused the spike of the prices. but the study has shown that their percentage of the purchases in the market was less than 5%, but they did help the growth of the market. But even if you remove that foreign buyers, if you take a look at the tax layers that it's available for Canadian investors, it's not as friendly as even our South partner in US. Market perception, we blame the investor. We not valued even the Canadian investor in the House of Commons when the opposition leader talks about that Canadian investors should be taxed differently because they have bought multiple properties. We cannot have in our society a perception of the blaming people who are helping the economy grow. Every investor that buys a property add a tax to the pool of the tax collection. If they do maintenance, they add to the employment sector. If they do renovation, they help the construction, small construction businesses. Any suppliers, grocery stores, furniture store. So the investment in the country needs to be supported, not to be blamed. Global opportunity. At the same time that the Canada created those tax policies, perception, negative cash flow, other countries such as Europe, such as US, such as United Emirates, they came with a much more better policies, welcoming investor, including Canadian, and that's why we see also better yield and better policy and alignment with the investor for other market. Pre-construction viability assignment is really frozen. That segment of the let's buy a property, let's buy a property, let's buy a contract, and then before even closing and doing anything, let's flip it. It's gone. That notion is gone. And I think, sadly, the scar of the assignment market will not be forget for by many investors for at least the next 3 to 5 years. Demographic strategy shift, moderate younger investors prefer cash flow and flexibility. Younger investor, they do not think like the older investor that they believed firmly that the real estate is a long run. They are looking at the investment in real estate for additional income to support their lifestyle. So overall sentiment for our investor market, including Canadian or non-Canadian, is basically at the moment is a frozen market, and the rationale is an exit strategy. Decision are analytical, not emotional. But this survey is simply on a residential market. In the next few slides, we talk about the major player in the commercial market too. So Canada for years had a policy of the protectionists. It did work in 1990s, in early part of the 2000 protectionism, it did work. We protected our auto industry, which is an assembly line. It's not even our own product. We have protected for years our airline industry, our travel industry, with telecommunication industry, but we no longer can continue in the new dynamic of the global trade in the market. The trade ecosystem has changed. A player such as China, an emerging countries such as India, Vietnam, they have really changed the game of the free trade market, not only in Canada, across the globe. So our investor, they didn't change their personality. Their personality didn't change. The risk reward equation changed by the policies that the government placed and forced them. And now the same government or the same philosophy of the government needs to change those policies. We need to shift from the protectionist to be a multilateralism country to welcome more investment in Canada. There are great news that you can hear in the last few weeks through the media. One of the news that I am quite optimistic, and I hope Canada take that bold move and make that decision, is regarding the fighter jet, that there's an opportunity to actually develop and build the fighter jet in a collaboration with the Sweden in Canada, rather than be dependent of the F-35, which is three times more expensive by our US partner. But there are going to be consequences. But I do believe that if we pay the consequences of perhaps not entirely severing our partnership with US, but reduce our dependence to the US, we will be in a better position in the future, particularly for our children, because we need to create different job market. We don't need to protect the auto industry the way we are protecting the auto industry. Canada is one of the leading G7 country creating car parts. I think we need to expand on the car parts rather than basically building the car, because car parts can be shipped and ship across the globe to different countries. We need to become a global suppliers. So there are so many changes Canada needs to do, but we really, more than anything else, we need to move away from our protectionist policies. I know this comment may not sound well to many of our audience, but that's the future that Canada can grow and can really tap into its natural resources and make sure that we have foreign investors coming and invest in the Canadian market. So uh, we need to fix the math for housing. We need to have a targeted tax incentive, fast track rental approval. Bill 60 is going to be introduced soon in provincial parliament. And there is a huge argument about the tenant rights versus the landlord rights. We need to make sure that the rental growth is within the inflation rate, so that landlord they can charge appropriately. Yes, we are not promoting the price gouging or unfair practice, but we need to change those policies that the people will invest more in the rental market. Fix the rules, maybe perhaps 5 to 10 years policy roadmap, rent tax, capital gains on investment property. We need to make sure that we give the confidence to the market that the capital will come back into the market. Reposition, as I said before, the investor as a supply partners. We need to acknowledge, we need to seek investors from across the globe that they come and invest in our housing market, in our economy. So if we continue on the narrative of the reduce also immigration policies, it will hurt us. High immigration policies for GTA was about 70,000 people settling on annual basis. Under the new limited plan, it's almost reduced by half. But even that reduction of the half, we have not been able to meet it, so we are down by 10%. We discussed this earlier. The less labor force, the less immigrants, the less doctors, the less nurses, the less engineers, the less trades will impact the economy. And we are not producing fast enough internally the labor force that can help our economy and can develop our economy. We are not going into the demographic recession, but it's done by design. We are growing at about 1% instead of 2% for Ontario and GDP, and perhaps even Vancouver, but less GDP at this rate could be okay, but we need to really focus then on the productivity of the labor forces that we have. And the productivity of the labor forces or skilled worker that we have, it needs a massive drastic changes in the entire system, which I frankly, I think it's difficult to achieve in our market. So housing trend. Let's get now to the final stage of our presentation, which is the housing trends. So as you can see across GTA, Ottawa, Durham, Niagara, London, and Simcoe, the condo purchasers are basically in majority of the market has dropped, but the housing, semi-townhouse detached has increased because of the price differential. In GTA, we see the condo purchaser, it's a good choice for the consumers because the prices have dropped and the consumers, they have more choices. And the housing in particular, detached or semis, are still relatively expensive, as we discussed earlier, sitting around $1 million. Very interesting for a first-time buyer that in 2025, almost 73% of them, they rather to purchase a resale condo versus a new home condo, which is good for a condo market. So the resale condo market is priced properly. It will move, as you can see in the pattern. And this pattern hasn't changed. Not too many people are really attracted to the pre-con. The pre-con was always a segment of the investment because of the notion of the flipping the papers. And it did work for many years, but it's not working at the moment. Sell to new listing ratio, that's another sign of that the market is not really crashing. As you can see, it's sitting anywhere between about 40 to 45% ratio. It's at the borderline of the 50%, which is basically a balance market, slightly into a buyer market, but it's not sitting at the ratio of the 15 or 20%, which caused the forced sell in the market. So the market is moving very steady. Detached condos detached versus condos, the price gap is almost about 50%, which now it gives an opportunity to both market move on the same parallel level, depend where you are. As you can see, for example, in the Durham market, the condo market is relatively represent in the range of about 475 to 500, and a detached is sitting at 850. Obviously, the detached market is moving in a better, similar pattern that we see in the York region. In Ontario, if you want to take a look at the overall market, or in the GTA housing market, you want to take a look at it, the red area map represent the average price of anywhere between $1 million to $3.5 million area, and the blue area is anywhere from about $700,000 to $1 million. So the market is soft, not distress. Investor, they have retreated. Condo market for sure is under stress. And a secondary market, such as Durham, such as Simcoe, such as Hamilton, Niagara, Burlington, are holding better. Construction overall is down, so we will have a supply issue perhaps in very near future. And the near future is not the next few months. It will be showing its issues in 2027. So let's take a look at large cosmopolitan city across the country. Montreal market is in a positive territory, +6, +9% year over year. Sellers are becoming very cautious in the last few weeks, and sales to listing ratio is at 60%. So speculation risk in the Montreal market is low. Toronto market is sitting literally at the million. Depending on which area of the GTA, prices are down year to year, anywhere between 4 to 7%. The market is flat, balanced to soft as we talk about it. Sell to listing ratio is 50%, and the cash flow is definitely negative, and the speculation risk is above the moderate, is quite high. And in our Vancouver, is the average price is about $1,150,000, flat to sluggish, and the market is balanced. The ratio is 50 to 55%, and the speculation risk is quite high because the Vancouver market has been always a market that has a high tendency to the investor market. Ottawa market overall metrics, it's great market. We see anywhere between 0.3 to 0.7% increase, depending on the segment. Very modest growth. And a single family, look at the townhouses, has almost 7% increase, and condo apartment is 0.1, so relatively flat. Interestingly, the number of the unit over year is up by 3.3%, and also the volume is about 6.5% up in the Ottawa market. Simcoe market, it's unfortunately down. The down is not because there was a different impact in that market. Simcoe market was one of the market that had a massive growth between 2021 to late 2023. Suddenly prices jumped almost about 35 to 40%. So it's finding its own momentum of the original prices. So all type of properties overall, that's the number you should look. All type of properties are down by 5.2%. Semi-detached got the biggest hit because if you take a look at the semi-detached versus the detached, so the average consumers, they prefer to tackle now with the lower interest rate, the detached market. There are a modest decline in townhomes. There's not much relevant information on townhomes. Condo townhouses, we don't have that much data, but the average price is sitting at $614,000, and the condo market is down by 15%. The condo market across the province is down because of the news that is coming out of the Toronto market. Peterborough and Quarter metrics. Single family detached is actually up in both territory. Townhouses are literally flat, I would say, and condo market again is down. And cottage and waterfront got the biggest hit because the big variability due to the affordability. And again, similar to the Simcoe market, they had a massive growth. Luxury market. We added this segment this year due to the fact that you should be aware that Remax represent the highest percentage of the luxury market, not only in Ontario, in Canada. But luxury market is a different segment. It's the 2 million and plus. You see a movement of the 2 to 4%, no major changes. And you got to understand the luxury market is typically controlled by the individual that they are in the higher income bracket or the families of higher income bracket. Ultra luxury market, we see very small movement because the number of the transaction is very limited. Moved from a zero transaction to 5 properties which exchange hand. Luxury condo market is down 5 to 8%. But again, not everybody, there is no high inventory of the luxury condo market because those are usually the condos market that they are over 2,000 square feet. Lifestyle and cottages, again, are down. Very similar to the fact that we look at the Peterborough market. So Muskoka, Lake Joe, and all the fancy area of the cottage market with the beautiful lakes or waterfronts, they are down. So what to expect? So this is the prediction that we're going to actually this year, we're going to do 2 years roughly prediction for you. Remax Hallmark team proudly has predicted the last 10, 12 years market, and in 90% of the cases, our market prediction has been solid and based on fact and the data that we collect on quarterly basis. So now the last quarter and up to the Q2 of the 2026 is a hesitation, is wait and verify. Hopefully by Q2 of the 2026, the tariff agreement will be ratified. January of the 2026 is a sunset clause for NAFTA or Canada, Mexico, US agreement because it was a 10 years sunset clause. And I think what the federal government is doing by having multiple multilateralism contract with the different countries, hopefully this contract with Sweden, the latest trip of the Prime Minister to Middle East, over $60 billion of the UAE investment in Canada, in AI, in natural resources. All of this will cause basically a momentum between the discussion between US and Canada and America. And they realize that we have the opportunity to grow independently. And hopefully we will have that contract. That's why that wait and verify will happen. Some people also, they are still hoping that maybe the Bank of Canada will reduce the interest rate, which I don't think so. From mid-2026, you will see small uptick, confidence, liquidity return. The Canadian investor, they have not left the country. They are still here, but they're just waiting for that moment. And because of the low inventory of the supply, we are very confident that in 2027 to 2028, you will see a new start. Is this new start going to be a new start of the 2021, 2022? Absolutely not. Our market has reset it. Our market, the title of this presentation was Market Reset. It's found its a new equilibrium, new pricing, which is a fair pricing of the market. And frankly, for professional practitioner of the Remax Hallmark, that they are full-time in this business, this is the market that we want to be there. We have the market share, we have the brand representation, we have the quality of the realtor that they understand the market, they realize the data, they realize the change of the demographic shift, and the market will reemerge probably at the growth rate of the anywhere between about 5 to 8%, single digit. And beyond that, I wish I could predict, but at the moment, I don't have enough data to predict. So this is why this prediction. The next slide is an assurance and confirmation that we think that we are on the right prediction track. So if you take a look at the Canadian commercial investment metric, we see the retail market is moving. Yes, it is moving at a very slow pace. We see the industrial unit is year over year is really flat due to the leasing demand for the logistic warehousing. Interesting, we'll see the AAA vacancy at the offices is less than 2% both in Toronto and Vancouver, and is down again by 0.26%. Multifamily, we see the rental market, multifamily softening because of the inventory of the condo market. And overall, the macro overview, we see just a 3 basis point, which is flat. But the year-to-date transaction is quite down. Yes, it's 34.5 billion versus about 65 billion. But we see that basically the market is on a flat and a recovery move. When you look at these numbers, these are the real big players in the market, that they have massive billions of dollars of the investment in the market. And when you see the numbers movement is very flat or slight up or slight down, it's a confidence to our economy and the word of the resilience that we started doing that. If you take a look at also the overall market across Canada, beside Edmonton and Saskatchewan, which basically the month-to-month price changes, you see only 1.1 and 2.39. The rest of the country is less than even 1%, 0.3%. For example, in Barrie District, you will see in Toronto market, similar pattern, Greater Vancouver, 0.8 of the market. And so it shows to you, if you take a look at the right-hand corner interpretation, you see mostly flat, mild softening. And so we don't see a huge number of the plus or minus of the even single digit or double digit. So these are all the confirmation of that our market is sluggish, is resilience. And the reality is you have to find and accept these are the new prices. We understand as a practitioner in this business that some sellers, unfortunately, they have bought in 2021, 2022, 2023. I would not say they made a bad decision or made a big decision, mistake buying at that time. That was the market at that time. We wish that we could change the narrative of the market and bring the prices back up to 15 or 20%. No, we cannot do that. That's the end of our presentation. Now we will open the floor for question, and thank you very much for listening to.
Thank you for that, Steve. We have a couple of questions here. First one's coming from Wendy McAdoo from Kingston. What is the prediction for secondary markets like Kingston or other smaller tertiary market areas, such as the cottage market?
So secondary market with the close vicinity, Wendy, to the labor market, one is Kingston. Kingston overall has a good employment sector due to the university. And because of the affordability and the beauty of the Kingston is between the two large city, Ottawa and Toronto. It will be steady, it will be flat, and there will be more movement of the population as we have predicted in the last 5 years towards those cities. Cottage country, unfortunately, basically gonna have its own adjustment as we have seen across different market. So I don't see a big major spike in a cottage country. I might see actually further drop with the cottage country, but I think it's really close to the bottom line that he has discovered his price point.
Next question comes from David Brown up in Simcoe County. Can Canada successfully diversify its trade relationships in time to avoid US tariff threats, or do you feel that midterms will offset the threat and CUSMA will be replaced with a new trade agreement?
Uh, So President Trump did one thing smart back in 2016, which was a sunset clause. Sunset clause, NAFTA didn't have expiry date now, which is they rename it to COSMA, which now has expiry date up to January 2026, which is the 10 years. But Mr. Trump also, or US politician, they are noticing, I just came back from US, they are noticing that all the tariff aggressive approach of the Mr. Trump is impacting the US. Tariff is simple. Tariff is passed to the consumers. Mr. Trump can add 10, 20, 30%, but eventually, let's say even that Canada doesn't export any product to the US, but they got to bring some product from other part of the globe. And the way he's behaving, he's adding additional costs to this export product. And what's going to happen? Those additional costs is being added to the cost of the receiver of the product in US or the businesses, and they will add it to the consumers. We have seen it now in US that the real estate market is really moderated. The real estate market is in some part of the US, such as Florida, it's literally the inventory is increasing drastically. But we're also seeing some movement in the large cities such as New York and Boston. The market is still is healthy, but it's not as healthy prior to the President Trump. And I think the Supreme Court ruling and the midterm, yes, David, it will definitely force Mr. Trump to have a different approach. Uh, how fast? I think what federal government, Canadian federal government is doing by all these talks with the different global partner is really sending a message to US. As an example, do you want to lose 80 F-35 contract with Canada? Because Canada right now is ready to sign a contract with Sweden in creating 10,000 jobs. And those fighter jet will cost us one-eighth of what is F-35 is really costing us. So I think the federal government approach is a smart. Yes, I know the consumers, also the average Joe public, they are really frustrated because there were promises that we will have an NAFTA agreement by July. But unfortunately, we're dealing with an individual that really is not stable, which is called Mr. Trump.
Next question comes from Bob Bellamy up in Simcoe County as well. Actually, Simcoe or Peterborough, I'm not sure. Sorry.
Simple.
It says, Steve, would you expect the market to recover slowly in 2027, 2029, similar to 1993 and the 1996 market?
Yeah, exactly, Bob. You nailed it. So the market right now, as I said at the beginning of the presentation, we are in a speeding zone camera. We are moving steady, which is nice, which is nice. We are not going down. The difference is in 90s, we were going down from 1992 all the way to 1997. And in 97, we actually end up having what we have right now, steady, flat market. I see small uptick, Bob, in 2026. And then in 2027, further uptick. And I don't know about 2028, 2029, but I do know the stats, the data all support. We don't have enough housing, even if we are bringing 350,000 newcomers to the country. So the market, no matter what, it will have a rebound. What speed of the rebound, no one can predict.
Okay, the next one comes from Dave Moore, have you looked at what might happen with new supply of commercial properties outside of the office space?
So a majority of the business says banks, even federal government, provincial government, as you probably noticed, starting from the September of this year, with the latest date, January of the 2026, they have recalled all their employees and they ask them to be at work. Some of the provincial or the city work official, they have now realized during the COVID, they have hired so many people because of the virtual services. Now they don't have enough space to house those employees. As a matter of the fact, I know one details information with the city of the Vaughan. They have decided instead of expanding rapidly their square footage, they create a hybrid model. 3 days work at the office, 2 days from home. And I do believe the hybrid model will be the virtual model that everybody was thinking that yes, the virtual model is going to be the basically the future. It's not going to be the future. The hybrid model is the future. And by one other aspect, Bob, if you take a look at the downtown Toronto, underpath of the downtown Toronto, the business towers are back to pre-pandemic era. And I do also believe that many businesses, small and medium-sized businesses, not large corporation, are moving their operation to areas such as Barrie, Durham, and a smaller city. But I think the responsibility lies within the local politician in Simcoe County that provide attractive, sensitive for businesses to move their offices there.
Okay, we'll move on to the next question from Dave. Sorry, not that one. We did that one. From Andy. With the projected recovery in 2027, what are the predictions of what that will look like, and how will a trade deal with the US or lack thereof affect what that will look like?
Right, the trade deal, the most negative impact that a trade deal has is a psychological effect. When you wake up as a business owner or as a company owner, small, medium, large size, you don't know, and particularly the suppliers, the manufacturer, when you don't know the outcome of the trade or tariff, you don't invest, you don't expand. And then it goes down the chain, go get to the average Joe consumers. If they are worried about their jobs, they are not going to move up. They may actually go move down, or they may not refinance because they wanted to do an investment in their backyard. So we need to really understand that tariff has had its massive psychological effect on people. If you are banking on rebound of the market, oh, interest going to go lower, guaranteed interest. We be lucky. We be really lucky due to a drastic market shift negatively if the Bank of Canada go back to 2 or below 2%, which I doubt it. It will not going to happen because it's also that means the explanation of what's happening in the US. The US market right now is suffering from the high interest rate. The consumers are demanding the drop of the interest rate because the inflation rate is high in US. So that's the most important. And then what would be the impact on a real estate market? Is it going to be right away everybody jumping into the market and start buying and we have FOMO and frenzy of the market? No. As I said to you, the condo market has left the biggest scar in the mind of the investor. Doesn't matter. A rookie investor that buys one condo or a pro investor that buys five condo or somebody that buys maybe half a floor. Uh, they are looking at the cash flow. And if the negative cash flow continues, they will not enter that market. So we will have less pre-construction market, but we will have pre-construction market for the people, mostly for end user or a long-term investors. So the impact of the growth, how much, what percentage, time will tell us. But I doubt it that it's going to be a double digit for the next 2 years. It will be a single digit, anywhere between 5 to 7%.
Okay, we have about a couple of more. The next question is from Matt Castles. Do you foresee any movement on development charges for builders or anything related to the land transfer tax in Toronto?
I don't think, Matt, I don't believe that the land transfer tax, the double land transfer tax in Toronto, are ever going to go away. The city is in massive deficit. The city constantly begging for province to give them money or federal. So that's for sure. It's not going to happen. And remember my comment about when the prices of the product are up, the suppliers are not going to suddenly drop the prices because they feel for the economy, they feel for the people. Is the same notion applies to the city. It's an average of about $400 million income for the city of the Toronto. So they're not going to drop that. Development charges is already started. Some cities, such as Mississauga, they have removed their development charges for rental purpose project. The federal government just made an announcement about the first-time buyer up to $1 million, so they won't pay the HST portion, which is almost about, it's not at 13%, it's almost about 8%, which is a good saving, and also CMHC program and the GST for a developer. So it is happening there, but people don't realize you can have a lot of these announcements, but somebody needs to build these projects. And in developers are refused, even within all these incentive, the developer majority of them are refusing to enter to the market and building them because the price of their construction with the price per floor is at the moment is equal. There is no profit, nothing left for them to basically upselling it because the price on the market is matched within the price per floor.
Very well. We have three more questions. Next one comes from Andreas and Nectaria. Do you see the Toronto condo resale market also having a recovery in 2027 or 2028?
I do believe the resale condo market is actually in the mode of Andrea recovery even now with the prices that I see in the market. I have said it through the entire 2025, and I am adamant to convey this message further into 2026. It's the best opportunity at the moment for investor and a first-time buyer. You cannot find the prices per square footage that you are finding right now ever. You blink your eyes in 2027, these prices are going to be up by at least about $150 to $200 per square foot. Right now, we can find prices per square foot in GTA as low as $650 per square foot. With the parking and with the locker, we can find the project with new project ready to close, no occupancy period at that price ranges. So the real estate market for condo resale, if you price it right, it will sell. It's very important if you have sellers or buyer on this webinar to understand what is your motivation. If your motivation is a scarcity, I got to sell because the market is going to go down, sit down and understand your purchase price, original purchase price, your current value, and the future value. If your motivation is you basically think it's going to get worse, let me get out of the market, you need a further discussion on that. So it's very important how we price these products. If you price it right, the market will absorb it.
Okay, second to last question. This one comes from Sayed Yunus from our Bayview Village office. A lot of sellers are concerned. If they don't sell now, prices may drop more next year. Should sellers sell now or wait and see what happens?
It's all depend on your financial, lifestyle, conditions. For 29 years, I've said the same thing. You don't come into the market because you watch the market. You need a roof. You need a house. You need somewhere to live. Real estate market, it is a long run. Yes, I understand some people are so concerned that they bought in 2021 to 2023, but also some people are concerned they bought in a good market in 2017, 2018, 2019, but they are now asking themselves, I wish I would have sold in 2022, 2023. Stop thinking that era. If you are in a positive compared to what you bought, hold on to your property. If you are negative compared to what you bought, then sit down and understand your financial circumstances and we need to understand why you want to sell. Your why is important. And that's that simple answer that I have for these two category of the sellers.
Okay, and the last question is from Max in Richmond Hill. What is your suggestion for agents in 2026?
Stop paying attention to the noise. Stop paying attention to the media. This business, it's about direct conversation with the public, educating the public, providing them facts, data that support your argument. And please have empathy for people, because consumers, some, they got to this maybe negative circumstances and a bad circumstances, not their fault, not even the realtor that maybe purchased for them their fault. It happened. Nobody can predict the market. Nobody predicted that the market would halt. Nobody would predicted that the Donald Trump will behave like this. So this is my recommendation. Focus, head down, conversation, 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 conversation. Educate your clients, educate your clients. And those ones that they have done it, many of our practitioners at Remax Hallmark with over 2,000 agents that we have, they have done it successfully and they have a success track record. We are in the relation business with the consumers, and the relation business is not for one transaction. The relation business is a long journey, and it's a lifetime. Any other questions, Sean?
Nope, that was all, Steve. Thank you.
Thank you very much, everyone, for watching this webinar. Look forward to see you around, and feel free to text me if you have any further questions.